global economic outlook continues to be bleak. Financial conditions are tightening and recession fears are mounting. Inflation continues to persist at alarmingly high levels across jurisdictions. Now we are in the midst of a third major shock, a storm, arising from aggressive monetary policy actions and even more aggressive communication. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Without venturing into any forward guidance which can be hazardous in the present context, I would like to state that our actions will be carefully calibrated to the incoming data and the evolving scenario.
It was an entirely predictable 50 basis rate hike from the Reserve Banks. Normally, a 50 basis hike would have raised heckles in the market and in political circles. But stock markets actually cheered with a near 2% rally, especially for the Nifty Bank. So shocking has been the currency market and the global turmoil that anything less than 50 may have actually been a risk both for markets and for the economy. But now the question is, what next? The governor absolutely and resolutely refused to give any guidance, as you just heard from him. So how many more rate hikes? Are we anywhere close to the peak? Also, are the GDP forecasts of 7% slightly lowered and the CPI forecast of 6.7% for the full year, 5.8 by end of the year, all of them, are they realistic? More importantly, what is the impact on the real economy? For all these questions, I have an elite panel with me. I have with me no less the chairman of the State Bank of India, Mr. Dinesh Khara. Also with me, Mr. B. Prasanna, Head of Global Markets Group at ICICI Bank, Samiran Chakraborty, Chief Economist for India at Citi, and Mridul Sagar, former member of the MPC and a Reserve Bank ED, now an economist with the NCAER. Gentlemen, thank you very much. I could not have asked for more informed people to guide us about the future of the policy and its impact. Mr. Khara, straight away to you, and thank you very much for joining all the way from London. So what is the sense you are getting? This is 0.5% is quite a bit, and most of the loans are being taken by retail credit in your own bank, more so for other banks. Do you think at this level we might see a slowing of the pace of loan growth?
Well, Lata, of course, the first reaction could be what you just mentioned. The pace of the loan growth might slow down. But I would like to go a little deeper and would like to draw your attention to the fact that we have already seen about 140 basis point increase in the repo rate for in the current year itself. And we have actually seen that the growth as far as the banking loan book from the banks are concerned, it is witnessing a very healthy growth, almost as high as about 16% plus. So I think what you mentioned in terms of 50 basis point, perhaps it was almost factored in by all the participants of the market. And ever since the 75 basis point hike was announced by the Fed, we were all expecting that it is going to be 50 basis point. So to that extent, it was not a shock in terms of expectation. But yes, of course, your second question relating to will it have an impact on the borrowing from the
small guy,
from banking system. Yeah, I think it will not have a very significant impact. I just did some bit of a back of envelope calculation in terms of EMI and its impact, and could figure out that overall the EMI impact on the EMI is somewhere. It is somewhere between 3 to 4% of the EMI amount.
Okay.
So I think, to my mind, it should not be a dampener, because so long as the demand is strong in the market, and all of us have seen that last about 2 quarters onwards, we are seeing a very healthy demand trends.
Okay.
So I think, though momentarily it might impact, but eventually the decisions taken when people come for the borrowing are generally having a long-term perspective in mind.
Okay.
And we're all aware that, this kind of though Honorable Governor has also indicated that the growth is going to be little slow, but I would say that it is still better than many other countries across the globe, and it is still a very healthy growth trend which is expected to really emerge.
Okay.
And India continues to be the shining star.
Prasanna, do you think now it has to be evened out? Now deposit rates are definitely going to rise at least as much as lending rates, no? On an average.
Lata, I can give my views. I will give it as a market analyst and talk about the general banking system, Lata. So it's nothing to do about
general, not
my
ICICI.
specific bank.
Yeah.
So I think I would also tend to agree with what Mr. Kara was saying. You have to remember one thing, Lata. I think what has happened so far is that the increase in repo has translated to a large extent to the increase in the wholesale deposit rates, the CD issuances by banks, and so on and so forth. But what has not really impacted so far is the retail deposit rates, like you rightly pointed out. But also bear in mind that the retail deposit rates for the banking system overall would be only around, say, 40% of the overall cost of funding profile of the banking system. So even if, for example, a 100 basis point increase were to happen in the retail deposit rates, even if, then since the deposit mix is to talk about, the increase in rates is going to be to the extent of 40-45 basis points on the overall cost of funds.
Okay.
Because bear in mind that the CASA rates don't change broadly, and also bear in mind that the wholesale deposit rates and the CDs have actually changed already.
Okay.
So to some extent, it's the catching up of the retail deposit rates with the change in the rest of the interbank products, so to speak. But it is not really a one-on-one comparison that you can do with the deposit rates and the lending rates because of the funding mix of the various banks.
Okay. Fair enough. The more pressing problem is how many more hikes. Now, on that, Mridul Sagar, your views. Do you think we have to go sizably into real rates from here on, since growth is not that badly off? So where would you place the real rate peak?
So, Lata, I would say there's still some catch-up to do for the RBI. So some more rate hikes are possible and should be undertaken. I mean, the terminal rate, as I had put up way back in June, should be round about 6.5 or so. I had mentioned that RBI would become data dependent once the rates cross at 6%, the policy rates. So it's very much evolving around that line. And the problem is that the real deposit rates still haven't gone into positive territory. So I think from the banker's point of view, I think it is important that deposit rates have to go up from here. We should get out of the financial repression regime where deposit rates are still negative. And that will bring about the right balance also in the sense that even with some lower NIMs, from the economy point of view, I think it is very important that those rates rise from here.
Samiran, your reaction, actually I was going to come to you with that as well. Are you confident of Reserve Bank's 5.8% in the fourth quarter? And as well, do you agree that rates have much more to move, 60 basis more, as Mridul Sagar is saying?
So, Lata, today we have learned two things from the RBI statement. One thing is that RBI is quite closely watching the global central bank tightening and the negative spillover effect of that in India. And the second thing that RBI has quite clearly mentioned is that the policy is still accommodative and not reached the neutral point by defining that stance in terms of real rates rather than just in terms of nominal rates. Now, both these things will point towards more rate hikes in the horizon. We think 6.5 is quite a possibility. If it is done in two stages, then that will be in December and February. And if our view is correct that Fed is also stopping somewhere around March, then maybe that will coincide with more or less when Fed is also pivoting. But the bigger question actually is that whether the policy rates can stay at that peak rate for a prolonged period? Or would we see a more quicker hike and cut cycle this time around? And our sense is that we will not be surprised if second half of 2023, we start seeing a rate easing also happening, because at this moment, it appears to us that the growth forecasts of RBI are a bit too optimistic, at least for next year, whereas the inflation forecast for this year is quite realistic. But for next year, there is a possibility that RBI can follow what in economist parlance we call opportunistic disinflation, where when inflation comes around below the target range, then the RBI can promote growth a little bit more than what they are doing on the inflation front.
Oh, that's important. So they can cut even before it goes to 4. Even if it goes to 5, RBI can start cutting. Now, this may sound like jubilation to those to viewers who are listening, but the subtext of that is growth needs help. RBI's 6.5% forecast for next year seems under threat, is what Samiran is telling us. We'll scratch that point a little more with our bankers in a minute after this break. Welcome back to our monetary policy special. I have been speaking with perhaps the most elite of panelists. I have with me SBI Chairman Mr. Khara, Prasanna, the head of global markets at ICICI, Somran Chakraborty, chief economist at Citi, and Mridul Sagar, former MPC member and ex-RBI ED. Gentlemen, thank you very much for your patience. Mr. Khara, I know I can't hold your patience for much longer. Two very quick questions. Would you worry a little bit about the Capex cycle? Are you, there are growth clouds more than interest rate clouds. Your thought on that?
Well, I think it might have some momentary effect, but nevertheless, when it comes to the investment Capex cycle, we have generally seen that once the capacity utilization inches towards 75 to 80%, there is a very clear visibility in terms of the investment expenditure. And if we look at though 140 basis point of the increase in interest rate has already happened in the current year, but we have got a strong pipeline which is still seen. And interestingly, almost about 70% of that pipeline is coming from the private sector. So that very clearly augurs well in terms of the likely scenario in terms of as far as the investment expenditure is concerned.
And another quick question. I got your point,
Yeah,
sir. Another quick question before I let you go. This is not connected to policy, but there is an expected loss, credit loss discussion paper that is coming. So we will go towards Ind AS. Does that worry you if Ind AS is imposed, say, FY25? I don't see it in FY24 if it is only a discussion paper now. But you think banking system is good to go for Ind AS?
I think if we look at the kind of gross NPA and the net NPA which is there in the system today, and the kind of PCR which the banking system is holding today, perhaps it is the right and opportune time to really evaluate our migration towards Ind AS. It might have an impact when it comes to the stage 1 and stage 2, but even stage 3 also, there would be a recalibration which will happen. And I think it's a welcome step which RBI has initiated today in terms of going for a discussion paper on the subject. It might have some impact for the provisioning, but I think eventually it will be in the overall good in the long term.
Okay. Thank you very much, Mr. Khara. Really kind of you to spare time for me all the way from London. We have to now discuss what it immediately means to the market. This is a discussion paper, and maybe a year down the line, banks have to provide more, but we don't have to worry about it now. Prasanna, I wanted more your thoughts on where do you see the 10-year peak, the 1-year OIS, and more importantly, rupee. Do you think the threat is over for now?
So, Lata, on the bonds, very quickly, I think we are back to the grind, so to speak, with the global environment being bearish. We've seen this policy which has come on expected lines, and we've seen the governor kind of tick all the right boxes, very calming influence. So we've seen that behind us now. But now we'll have to again look at what's going to happen in the US as well as in the UK, as well as what's happening to the bonds there. And what has actually happened over the last month or two is the Indian bond yields have not really, I would say, reacted as much as what it might have had, basically because of the expectations on the global bond index inclusion. And a lot of discussion has already happened under that, so I don't want to really, extend my arguments on that. But just to say that if the inclusion does happen and the announcement happens next week, then you would see, bond yields falling by around 15 basis points. And on the other hand, if it doesn't happen, we'll probably see the borrowing program grinding bond yields gradually going up. And the other thing which is affecting the bond yield curve is, of course, the heightened liquidity shortage that you were talking about, in the sense that now the interbank rates are tracking MSF rates and not really the reverse repo rate, as was the case nearly a year ago. And so to that extent, there is a natural grind up in terms of where bond yields are. So, and also to add to that, the fact that the SDL supply is also now coming in, going to hit the market in the second half. So all in all, I think I would call a range of around 735 to 760 if nothing happens on the global bond index. Okay. And I'm also capping it at 760 primarily because I do see a lot of insurance-driven, bank, HTM-driven buying, which is happening when really yields go up. On the currency side, Lata, I think, again, over the last 2 to 3 weeks, especially post-CPI, it's really been dollar strength all the way because the interest rate expectations on the Fed has really got repriced in the global markets. And during that period, we've seen the dollar appreciating against all the, the G7 currencies quite substantially. And INR has also, kind of fallen prey, much less though than what the others are. So having said that, I do think that the period of dollar bullishness is still going to remain globally. But on the other hand, I will also say that incrementally there are, more and more reasons to be less bearish on the INR beyond this level. Maybe a level of 82.5 is what possibly it can go. And I'm basing myself on the fact that the dollar strength can actually start to wane as we go forward. Because the arguments of differential interest rates, differential growth and differential safe haven demand, which is what has driven the dollar so far, will probably, kind of get less and less important as we go forward.
Well, since we have a city economist with us, that question to you, Samiran. There was a seminal mood shift in the currency today, not entirely due to the monetary policy as much as the dollar peaking off. Is 83 on the cards, or is 82 likely to be, for some time?
Our global strategists, they believe that there is still some dollar strength left in the system. And that's why we are in the short term thinking of even 83 happening. But this could be a very orderly move in the currency markets rather than being knee-jerk in nature. We, at least at this point of time, feel that the worst of balance of payment situation is behind us. Second half, both the current account deficit as well as the overall BOP should look slightly better, giving RBI a bit more wiggle room to operate with. And on top of it, as the governor has mentioned today, that a large part of the FX reserve decline is on the back of valuation adjustments and not directly interventions. So these valuation adjustments can work on the other side also. If what Prasanna was referring to, if for some reason the Fed pivots and yields come off, then that automatically leads to our FX reserves optically looking higher. And the same can happen if the dollar cycle turns at some point of time over the next 6 months or so. So all in all, I feel less worried on that front on RBI's ability to defend the currency.
Okay, that's very welcome if you think you are slightly less worried. Mridul, the most important question to you really is, how will the Reserve Bank look at that 4% target, or rather the MPC? They have to write this letter to Parliament defending their inability to bring interest rates below 6% for 3 quarters. It's going to perhaps remain above 6, as you yourself said, for 1 more quarter. Will they not attempt 4% at all? Is 4 to 6 going to be their target?
Yeah. Lata, if you allow me, let me first quickly react to the discussion which was going on before this thing. In my view, the global financial markets are still into choppy waters. I mean, it's too early to sort of say the Fed has peaked. Barry Eichengreen and NCR took the call of 5% terminal rate for the Fed. We still sort of believe that. And there is still, on the currency market, so much is happening. I mean, you look at the yen-dollar volatility, I mean, from the fall, it's back to 145, 144 levels after the Jackson Hole speech of Powell. So dollar strengthening is something we can't really say is over. I mean, we still have to wait and watch how this pans out in terms of it. And I think the EM currencies will still need to bear some sort of onslaught in the coming period. Equity markets correction is also not over, in my view. There's some work which has come from the Chicago University earlier this month, which shows that the investor habit formation is such that we could see a short-term interest rate rise would lower output and consumption levels, but will raise risk aversion and amplify the global shock.
Okay.
So the house price bubbles could burst in places, Australia being one of the immediate evidence of it. So I think we need to be very trained and very nimble and flexible footed, as the governor had really explained in speech also. So at the moment, 4% may not be the immediate possibility. So I think it's okay. I don't think there needs to be a stigma attached to RBI explaining the letter. These have been very special circumstances in which inflation has gone up. So what one needs to watch out is how credibly the central bank explains why it has gone up, what it will do to bring it down. So these are very critical next forecast. Okay. So it's okay if inflation stays high into the next year, but that only means that the monetary policy needs to remain tight for some time now.
Fine. Point taken entirely that in special circumstances, stability is more important, financial stability, than perhaps adhering to the targets that were set in more normal times. It's been a most enlightening discussion. Mr. Khara, Prasanna, Samiran and Mridul Sagar, thank you very much for joining me. We wrap up on this special broadcast on the monetary policy.